Good day, ladies and gentlemen. It's my pleasure to welcome you on behalf of Linc Limited and SKP Securities to Linc Limited's Q4 FY23 and FY23 earnings webinar. We have with us Mr. Deepak Jalan, Managing Director, along with Mr. N.K. Dujari, Director Finance and CFO, and Mr. Sanjeev Sancheti, Utis Advisors LLP, IR advisors to the company. This webinar is being recorded for compliance reasons, and during the discussion, there may be certain forward-looking statements which must be viewed in conjunction with the risk that the company faces. We'll have the opening remarks by Mr. Jalan and a presentation by the management, followed by a Q&A session. Thank you, and over to you, Deepak ji.
Good afternoon, and a very warm welcome to Linc Limited's Q4 FY23 and full year FY23 earnings webinar. I will take you through the business and operational highlights of the quarter and the year gone by, while our CFO, Mr. Dujari, will share the financial matrices. I'm excited to share that fiscal year 2023 has been a landmark year as our company posted its highest ever revenue, profit and margins. While Pentonic sales continued to grow with its share at around 30%, Linc revenue also posted high double-digit growth. Further, export revenue was also strong and contributed over 20% to our top line. Hence, our operating revenue for the financial year 2023 grew by over 37% to rupees 487 crores. With Pentonic's sales contribution continuing to grow and increasing traction for our stationery portfolio, Delhi, we expect to achieve strong top-line growth in the coming years as well. In the pen segment, the company continues to have a strong presence with a market share of around 8%. With its uniqueness of design and its perceived value, Pentonic has become one of the leading brands in the affordable segment of the writing instruments industry in India. Since its launch in FY 2019, Pentonic is now a rupees 140 crore plus brand, which is a rarity in the writing instrument industry. Buoyed by increase in share of Pentonic revenue, further aided by increase in selling price of Linc portfolio during the year, gross profit margin of the company expanded to 31.2% in FY23, which is an expansion of 7.4% over the previous year. While gross profit grew by 80%, fixed overheads grew by 40%, thus displaying very strong operating leverage. This resulted in operating EBITDA growing by 185% and operating EBITDA margin more than doubling from 6.1% in FY22 to 12.6% in FY23. Consequently, the company achieved its highest ever PAT and PAT margin of 37.4 crores and 7.6% respectively. Linc 2.0. The results of the 5-pronged strategy embarked upon by the company in FY22 are now clearly visible, as the company has been able to achieve its highest ever revenue, profit and margins in FY23. While we continue to focus on our core strengths and the laid down strategy, strong demand for the company's products and significant opportunities in the export market should enable us to achieve high top line and bottom line growth in the near future. The strategies adopted by the company are as follows. The first is increased touch points. India has over 10 million non-stationary outlets, likes of kiranas, medical stores, pan stores, etc. And from nowhere in FY20, the company has reached to almost 1.4 lakh such outlets directly, thus taking its total touch points to over 2.4 lakh outlets. The company has also been able to broad base its penetration across India, and hence the share of revenue from South and West zones has increased from 27% in FY19 to 36% in FY23. The company expects to expand its overall reach to more than 5 lakh touch points by FY25, as mentioned in my earlier calls also. Focus on higher margin products. So we continue our focus on higher value and higher margin products, while the overall volume of pens sold grew by around 24%, Pentonic volume grew by over 53%. Quite a few products are under development in Pentonic portfolio, and one of them, priced at ₹40, is finally getting launched in this quarter. Apart from this, there are another 3 products which are under development and likely to be launched within this financial year under Pentonic portfolio. Inroads into stationery products. The company's foray into full range of stationery products through an exclusive tie-up with Delhi is progressing well, and the company achieved a turnover of around ₹25 crores in FY23 for the Delhi brand, as against just ₹11 crores in FY22. We expect to generate a top line of at least ₹75 crores by FY25 for the Delhi brand. Step up the existing capacity. To meet the targeted demand, we are planning to increase our manufacturing capacity at Gujarat by putting up an additional manufacturing facility adjacent to our existing factory. ESG. On the ESG front, the company has taken the following initiatives. Number 1, substituting plastic wrappers with bulk packing in paper boxes. This initiative saved about 60 tons of plastic in FY22 and around 90 tons of plastic in FY23. Next is we employ more than 1,200 female workers in our manufacturing facilities. Number 3, we also employ and provide training to a small number of specially abled workforce. Number 4, we support several NGOs who provide education to the less privileged sections of the society. The company is actively working on projects like recycling used pens. Consumers are encouraged to change the refill more often rather than buying a new pen under its Refill More campaign. These efforts will go a long way in contributing towards reducing the carbon footprint of our planet. Now, I would like to hand over the call to Mr. Dujari to provide updates on financial numbers. Thank you.
Thank you, Mr. Jalan. Good afternoon, ladies and gentlemen. Many thanks for joining the FY23 Linc Limited earnings webinar. I will give a brief overview of the financial numbers for the year gone by before we open for Q&A. During FY23, the company's operating income grew by over 37% from Rs 355 crore in FY22 to Rs 487 crores. With an improved product mix, increase in selling price of Linc products during FY23, rationalization of input prices, and strengthening of US dollar, the company achieved record profit in current period with operating profit margin crossing 31% in FY23. FY23 PAT stood at 37.4 crores, up from 8.13 crores in the previous year. FY23 EPS stood at 25.15 versus 5.47 in the previous year. The company continues to use its free cash flow judiciously and in the process had been able to reduce its net debt significantly over the last 5 years. From a net debt of rupees 62 crores in FY19, the company is now debt-free with a free cash of over rupees 7 crore as on 31st March 2023. The company has embarked upon a modular expansion plan in Gujarat next to its existing facility, while the basic infrastructure is being created to double its capacity to 20 lakhs pen per day. Equipment and machinery will be added in a modular fashion in sync with the demand needs. The total cost of the project is expected to be around 50 crore. Infrastructure for the above will be completed in FY24 at a cost of around rupees 17 crore through internal accruals. The first phase of the equipment to increase the capacity to 15 lakh pans per day will be completed in FY25 at a cost of around rupees 18 crore, which was originally envisaged for FY24. The second phase will be taken up subsequently at an estimated cost of rupees 15 crore. Demand growth for FY24 will be met through existing capacity and stepped up outsourcing, which has already been tied up. On the back of strong demand for the company's product, better product mix, and improved margin, the company is revising its guidance upward to achieve a top line of over rupees 750 crore by FY25 with a CAGR of around 25%. During this period, the share of Pentonic revenue is expected to grow to around 40%, while Relay is expected to contribute over 10%. We expect to achieve an annual operating EBITDA margin of about 15% by FY25. With modular expansion and judicious use of debt, we also expect ROE to be about 21%. We continue to remain focused on our long-term goal of sustainable growth, profitability, and a strong delivered balance sheet. With this, I will leave the floor open for Q&A. Thank you.
Thank you, Mr. Dujari. Anyone who wishes to ask a question, request you to raise your hand. We'll unmute you and take your question to the management. We'll wait for a couple of minutes to have some questions lined up. The first question is from the line of Anuj Sharma. Anuj, please go ahead.
Yeah, thank you. Am I audible?
Yes, loud and clear.
Yeah, thanks. Few questions. First of all, congratulations for the good number. See, we have spoken about imitation by others as a part of strategy, and we have anticipated that. So my first question is, could you talk a little bit about how are we staying ahead in the game? And typically, how much lead time does a new product have before it gets imitated? We have also said that it's good to get imitated rather than imitate others, but some bit on this strategy, please.
For the lead time to get imitated, I think that's what is your question. It takes about 6 months time. So let's say if we launch a new product and if the product is doing well in the market, and from that point, if the competition picks it up, they need about 6 months lead time to imitate the product. Was that your question?
Yeah, so that's part of my question. But the other thing is then to stay ahead in the game, new product introduction, that's the only way out. Is that correct? Yeah,
definitely. So, our strategy has been that whenever we launch a new product, we monitor it very closely in the first month or the second month of the launch. And if we feel that if we observe that the product is doing well in a select market we have launched, we scale it up. I mean, scale it up in a way that, before the competition copies it, we already have an edge in the market. So that has been the strategy so far. Secondly, whenever we develop new products, they are, of course, it takes about 6 months time for us to design and develop a new product, rather more than 6 months sometimes. And the products are, designed by, top class designers and engineers. So that is another way that we try to be different and stand out in the market.
Yeah, that's helpful. My second question is, earlier we had said that we would imagine Pentonic contributing, Pentonic portfolio approximately 35% by 25, and I think we have raised it upwards to 40%. Now, is there a limit beyond which you would want to innovate or seed a new product brand, or do you think Linc and Pentonic 2 are good enough along with Delhi to take us at least for the 3 to 5 year journey?
Yes, so while Pentonic actually started as a product brand, but now Pentonic has become a brand umbrella itself. And so whatever new products which we are launching, they are launched under Pentonic umbrella only, so Pentonic brand. So we don't feel any need of launching another new brand. So all our new products are to be under.
Right. And one final before I come back in queue, our exports have also done well. And I think in your presentation, that India exports has grown by 23% CAGR. So in our total growth strategy of 20-25%, exports will also tag along the same growth rate. And what is driving exports? That will be helpful. Thank you.
Yeah. So I would say that, Pentonic is not just doing well in the local market, but it is also doing very well in most of the markets where we have launched. So so Pentonic is actually driving our revenue growth and profits even in the export market.
All right. Thank you so much.
Yeah. Thank you, Anuj.
Thank you, Anuj.
Also, Anuj, we've shared a little late though one strategy presentation where we have kind of covered the strategy of export, which you would be able to see it probably because we shared it just 2 hours back.
Yeah, all right.
Friends, there are a couple of participants who've posted multiple questions. If possible, request you to raise your hand so that the follow-up questions can be asked immediately. The next question is from Zaki Nasir. Zaki, please go ahead. Please unmute yourself and go ahead.
Can you hear?
Yes, Zaki.
Hi, Zaki. Yes, hi.
Hi, Deepak Bhai. Congratulations to you and Linc for the phenomenal performance, sir. As Dujari ji pointed out, 2025 you have a top line target of 750 crores. Would it mean that the margins would expand from these levels, sir, or these would be slightly upticked margins due to raw material advantages?
I would like to be a little conservative and would say that we would like to at least maintain the existing margins, because going forward in next 2 years, we don't know what is going to be the polymer prices trend. And secondly, as we increase our market share, we have to invest more in the advertising and promotions. So I think I'll be happy that if we are able to even have a slight uptake in our current margins.
Would be good, sir. Sir, the other question is regarding your relationships with Delhi, one, and Mitsubishi Pens, the other. Sir, it looks like stationery is a huge market. I think you can do much better than 75 crores in 25. What would you want the nature of relationship with Delhi look maybe 3 to 4 years hence? Are you looking at some kind of a manufacturing base in India, or that would come at a later stage, sir?
So Zaki bhai, definitely, as you can understand, that it's not actually our long-term plan to just do the trading of Delhi brand. So definitely we have plans in future to produce some of Delhi products in India. Maybe in association with the company Delhi. So, but it's at currently it's a very nascent stage. So, but yes, definitely, that would be the direction going forward. But right now, I cannot comment for the near future.
I understand, Deepak. And Deepak, see, as Pentonic also moves up the value chain, how would you handle your relationship with Uniball with Pentonic moving up the value chain, sir? I mean,
that's a good question. Nevertheless, actually, while we are launching some higher value products like 40 rupee pens under Pentonic. Fortunately, the Uniball prices have also gone up in last couple of years. So a product which we used to sell at 50 rupees about 5 years back is today 80 rupees in the Uniball portfolio. So so I think we are still going to have some price difference in both the brands, and it should not really conflict much. There could be some gray areas in some products, but largely there would not be.
Okay, because sir, I mean, I mean, I tend to see the quality of the pens. I think Pentonic has almost equal. I would say equal best quality imported pens. So, I mean, would the nature of relationship with Mitsubishi change in the future, or it's still nascent? I mean, you would just see how things pan along on the way, sir.
Yeah, so actually really a very difficult question to answer, but you can understand that while Uniball we are only handling for the Indian market, and Pentonic, since it is our own brand, so we are selling across the world. So so I don't see much issues here, and we are able to so far we are able to manage. So. And let's see, we'll cross the bridge when it comes.
Deepak, one general in piece of info, what would Uniball as a pen sell across the world, sir, in terms of value?
Uniball's revenue across the world, I mean, the company. In terms of Indian rupees, I calculated it may be little off, but it is around 5,000 crore Indian rupees, equivalent to 5,000 crore Indian rupees.
Fantastic, sir. So we have a large headroom on Pentonic. Thanks a lot, sir, and best of luck to you and Team Linc, sir.
Thank you, Zaki bhai. Thank you for your trust.
Thank you.
Thank you, Zaki. Friends, anyone with a question, request you to please raise your hand. We'll unmute you and take your question. Well, some participants line up. Okay, there is one. Binoy Jariwala. Binoy, please go ahead.
Am I audible?
Yes, Binoy.
Yeah. So sorry, I'm a little new to the company, and therefore some of the questions might be pretty basic questions. So I just wanted to understand what percentage of the overall revenue comes from our agreement, distribution agreement with Uniball.
So currently, so in this financial year, it's about 13 to 40% of revenue which came from Uniball in our overall revenue.
30, right? 30%.
No, 13, 13.
13 to 14% of overall sales.
Yeah, of overall sales comes from Uniball.
Understood. And under this agreement, do we have exclusivity? How does it work? Like, what is the term of the agreement? What is the nature and scope of the agreement?
All right. So so far Uniball is concerned, I would like to share that Uniball, they have 13.5% shareholding in Linc Limited. So they are, of course, a significant shareholding they have in the company. So you can understand the level of interest they have in our company. And of course, this distribution is just for the domestic market.
Okay, so is this like purely distribution agreement where you have to purchase from and sell it in India, or do you also manufacture these products on your own and pay royalty?
So no. So there is no such agreement. And frankly speaking, we started working with Mitsubishi in 1992, and at that time we did not even have any agreement. So even today we don't have any agreement with them. Any written agreement with them. But as you know that they have 13.5% shareholding in our company. So of course we are exclusive. By understanding, we are exclusive distributors for them. And most of their products are imported as finished products. But there are two products which we are importing as components from them and assembling in India and packing and selling. And in future, of course, we've been talking to them for a couple of years that some of the products we can even make in India, but that might take some time.
Okay, so and likewise for Delhi, if you can just explain what is the term of the agreement. Is there an agreement in place, term of the agreement, scope of work, etc., etc.?
Yeah, same thing. Actually, similar thing for Delhi. When we started working with them just before COVID, and so we started working with them without any agreement, and we were negotiating on the agreement terms, and so generally their agreement terms are every year they renew it, which we did not accept. So we told them that there is no need of any agreement right now. Let us work for 5 years and you see our potential, and then we will talk about the agreement. So when we took over the business, Delhi business, it was very meager. And as we delivered a handsome number of 25 crores, they are very excited to deepen our relationship. I don't want to comment more on this at this point of time, but we are going to our relationship is going to be more deeper going forward.
Understood. So likewise, as per my understanding, what you're trying to say is that you import the products from Delhi and sell it here in India, and so far you are the exclusive importer and distributor.
Right, absolutely. Yes.
Understood. So,
Binoy, Binoy, can we keep this as the last question, and I request you to rejoin? There are many other participants are wanting to ask a question.
Yeah. I'm just doing the last question.
Thank you.
So the last part I wanted to actually touch upon was on the current capacity and the capex, and what kind of turnover can the current capacity generate at full utilization.
So generally, see, so we have a mix of our own capacity as well as outsourcing. So the ratio is about 50-50, which we like to maintain. Just to give you some insights, like last year, I mean in FY23, we sold about 75 crore pens, out of which almost 50% of which was outsourced and 50% was manufactured in-house. So because of this outsourcing, we are able to, use our capacity to a very decent level. So you can say that on average, the utilization would be in the range of 85 to 90%, considering the lean months. So like in the peak season, we are actually short of capacities. And for our forecast of FY25, we would be needing additional capacity of at least 30 crore additional. I mean, we'll be needing a 30 crore pens capacity, of which we plan to outsource about 50%, and the remaining 50% we like to produce in-house by increasing our capacity. And the capex for which we've already mentioned in our strategy presentation, but for the benefit of everyone else there, I would like to mention that in FY24, we had, in my last earnings call, I had mentioned that we will be making a capex of 35 crore rupees in the infrastructure as well as first phase of plant and machinery. Since we have already tied up, our requirement for this year, with our vendors, we don't need to invest in plant and machinery in this year. So we have scaled down our capex to about 17 to 18 crores only in this financial year, which will be just for the infrastructure. And then in FY25, we would put in another 17-18 crores to increase our capacity by that 15 crore pens annually. So that will take care of our FY25 business objective.
Binoy, request you to rejoin the queue, please.
Sure. Okay.
Thank you.
Sorry, Vinay, we'll come back.
We have a question from Saket Mehrotra. Saket, please unmute yourself and go ahead.
Yeah. Sir, I wanted to understand, this jump that we've seen from FY22 to 23 in our top line. So obviously one part is on sales. So if you could just give us a sense of how much of this has been on price increases and how much of this has been, let's say, in terms of your raw material costs that we've seen this expansion in EBITDA coming in.
You mean you're talking about the margins, is it?
Right.
Yeah. So yeah, as Dujari ji covered in his speech,
was because of
3-4 factors as well.
There are 3-4 factors.
So one is, of course, as I mentioned, that the contribution of Pentonic portfolio has increased significantly, almost more than 50%, about 50.
So if you compare from 22 to 23, it is from 25% to 30%. So 5% expansion in 1 year.
5% expansion, yeah.
1 year.
So that is one. So there is an improvement in the product mix. And secondly, we were also able to increase prices of our some of the legacy products under Linc portfolio. So that also helped us increase our bottom line or the overall gross margins. And definitely the polymer prices, which were actually on a high in the previous year or even up to the first quarter of this year. But from the second quarter onwards, the polymer prices have moderated and continue to be moderate even today. So that has also played a significant role. And the fourth one, I would say that in exports, because of the rupee becoming weak against the dollar, it improved our realization in our exports. So these are the four main factors, I would say, which helped increase our gross margins, overall gross margins.
So Saket, just to add, from a mathematics point of view, the volume of pens grew by 24% in FY23, whereas the revenue grew by 38%. So that difference is basically the expansion that you are seeing that reflects into your gross profit margin and your EBITDA margin. Your revenue has grown at a much faster rate than your volume.
Okay. And secondly, sir, like in terms of the SKUs that we have in Pentonic, I think most of our SKUs are in the 10 rupee price point, if I'm not wrong. And now we are going to introduce 20 and 30, right? Is that what the strategy is with Pentonic?
Yeah, so in Pentonic right now, of course, our classic pen, which was the first pen to be launched under Pentonic, is a 10 rupee product. But then we also launched another product, which is at 20 rupees, which we have been, which we launched actually in the middle of COVID. So that is another product which is picking up and doing well. And so these are the two price points. Of course, we also have a gel pen at 10 rupees under Pentonic. And now, as I mentioned, that we are launching a product at 40 rupees, in this quarter. Actually, this product was actually supposed to be launched last year only, but it got delayed. So yeah, so our strategy is that to have products at various price points, under Pentonic.
Thank you, sir.
All right, thank you, Saket.
Thank you, Saket. We have a question from Pritesh Chheda. Pritesh, please go ahead.
Yeah, hi. Can you hear me?
Yes, Pritesh, loud and clear. Please go ahead.
Yeah, sir, my question is, from the 400 crore revenue that we had in March 20 to about 490 crore today, which is about 25% growth. In this 25% growth, what would be our India growth and what would be our export growth? And what would be a volume growth in this 25% growth number?
Yes, so I really like your comparison, because I always tell my people that we have not grown, we should not calculate our growth from the previous year. We should calculate our growth from the pre-COVID period. So yeah, so it's actually about 25% growth when you compare, to FY20. The growth percentage incidentally has been similar, both in the domestic as well as in exports. And volume would be around 17% volume growth overall, compared to FY20.
Yeah, which is, and the revenue growth is about 23-24%.
Yeah, about 25.
Yeah, a little less than 25%.
Okay. And at the same time, what would be the market growth rate for pens in India?
See, generally the market growth is estimated at about 7 to 8%. So yeah, I mean, Fortunately, we have done better than the market growth rate or the average market growth rate. Yes.
Okay. And can you help us know, this industry also has that sticky price point pens, 5 rupee pen, 10 rupee pen. So that less than 10 rupee pen portfolio mix, how it would have reduced or increased in this 2-year time phase from 400 crores to 487 crores?
For our company?
Yeah. So less than 10 rupee pen contribution to sales, has it reduced?
So I think we already mentioned that in our strategy presentation that the contribution of the 10 rupee and above products has increased.
It has increased because Pentonic has increased.
So that will answer his question.
So basically, if you look at the percentage of growth, the whole growth of Pentonic is driven by 10 plus segment, right?
Yeah.
And 10 plus segment, if you look at the growth, then Pentonic share has grown up from, let's say, FY20 was 17% to today about 30% of your total revenue. So that's the expansion. So obviously the 10 rupee pen has grown at a much faster rate than the 5 rupee pen.
Yeah. And another figure I'd like to share with you is,
Sir, I missed a bit. So you gave an analogy of 10 rupee pen, right? 10 rupee pen has increased from 17 to 30.
17 to 30, yeah, because Pentonic is nothing is below 10 and above.
So 10 and above is 30% of sales, and 10 and below is now 70% of the sales, right?
Not 70, because you have Mitsubishi also, which is again above 10. So Mitsubishi is another 14%. Right. So you can say about 44% is 10 above,
right,
and the rest is 10 below.
Okay, so if I include Mitsubishi in that 17% also, then maybe 25-30% of your sales, which was 10 and above, is now 44% of your sales.
So the 17% doesn't include Mitsubishi because we were giving only the Pentonic share.
That's why I said, no, sir, I added the Mitsubishi part, right? It was 17, so I'm saying you 25 to 30 now.
Yeah, okay.
Right. So for an analogy perspective, 25 to 30% of sales is now 44% of sales, which is 10 rupee and above.
Yes.
30 from Pentonic and 14 from Mitsubishi, right?
Yeah, you're right.
Right. So this is a part of the portfolio which has grown faster than the less than 10 rupee portfolio. Less than 10 rupee portfolio may be stagnant or single digit growth rate.
Yeah, it is actually stagnant. Yeah, and even shrinking.
Okay.
So if you look at the presentation, you will see that the Linc has grown at from 4,400 to 1,500 in just 1 year comparison, whereas the Pentonic and both Pentonic and Uniball has grown at a much faster rate. The numbers are there. Slide 18.
The GM differential, the gross margin differential in this two portfolio would be what percentage?
So gross profit margin. So just to explain that, Pentonic would be 40 plus.
Right. Yeah.
Mitsubishi will be 20% because it's largely trading.
About 20 to 30%.
20 to 30% depending on product, and Linc is 25%.
Linc is about 25.
Yeah, now after increasing price.
25 to 30%.
Yeah, 25 to 30%.
25 to 30%.
This is gross profit margin, right?
Yeah, this is GP. Yeah.
GP.
Okay. And my last question is, what opportunities do you see in exports? Does the writing instrument also have that kind of opportunity which we are seeing in a lot of other sectors from export perspective?
Yeah, so there is a huge export opportunity, for us. And as I mentioned that, we are targeting a similar growth as domestic, even in the export market. And in our strategy presentation, we have already shown our global footprint, and we have also shared the growth of pen exports from India, which is about 30%. Overall growth.
So just share the slide also. We're just sharing it. You can also have a very quick look at that. It's a very interesting slide. Yeah.
Then you can look at it later.
But is it a white labeling opportunity or it's an opportunity under branded Linc pen?
So our 95% of our exports are under Linc brand or Linc or Pentonic brand. So yeah, so that is the advantage we have, that we are like building our brands in international market.
Okay. Thank you. And what I understand from your interpretation of growth and gross profit margin, so most of it is then becomes sustainable, right? Because between the 2 years, which I talked about, from 390 to 490 crore movement, the entire growth is greater than 10 rupee price point product, where the margin is 15% higher gross profit margin versus the less than 10 rupee product, right? So mix also has played a significant role in improving our gross profit margin.
Yes, definitely. So it's quite sustainable because the share of Pentonic is growing, and even if there is an uptick in the polymer prices, we should be able to sustain the margins.
Your share is against which players? Whose share are you taking? Who is the player who's a reasonably large player? Because you're taking share also in greater than 10 rupee price point products, so some competitor must have.
So, of course, there are several small and medium players and some regional players across the country. So, what I have observed is that the top brands are actually growing. Like Flair is another brand which is also growing. And but apart from that, there are several players, and I think we are taking market share of some of them. But more than that, as I mentioned, that premiumization is also helping us grow in terms of revenue as well as profits.
Okay. Thank you very much, and all the best to you, sir.
Thank you, Pritesh. Yeah.
Thank you.
Thank you, Pritesh. Friends, anyone with a question, request you to raise your hands and we'll take your question.
Yeah, can I have
Anuj, just give me a moment, please. Deepak ji, there are a few questions on the question board. May I take them up?
Yeah, please.
Okay, there are a few questions from Himanshu Upadhyay. India exports nearly $250 million of pens. What is our strategy to grow the exports and penetrate in the largest 3 markets of USA, France, and Germany?
All right. So we are working in the US market for last more than 5 years, and so the exports to North America from India is mainly in the third-party brand. So whatever exports you see, out of India are mostly under the customer's brand. But as a policy, we don't like to do that kind of a business, and we prefer that whatever we sell or export, it must be in our own brand. So that is what is taking some time for us to really make a breakthrough in the US market. But we are regularly talking to some potential distributors in the US, and you never know. I'm just waiting for that American dream to happen, and I'm sure that it will happen very soon. So that is our strategy for exports to the US. So far, Europe is concerned, we have a distributor in Europe, and these are tough markets, frankly speaking. France or Europe, these are tough markets. Because Germany itself is a producer of several, brands, popular brands, of writing instruments. So we have a distributor, but more than France or other European countries, our eyes are more on the North American and South and Central American market.
Okay, the follow-up question was, what are the top 3 priorities for us in FY24 and FY25?
Okay, so the top priorities are to make Pentonic bigger and bigger. So that is the number 1, because it helps us increase our top line and bottom line both. Number 2 is, of course, expansion of distribution. So as I've mentioned in our strategy presentation that, and even in my remarks, that we like to have 500,000 touch points by FY25. So that is our another going to be the focus. And thirdly, of course, the export potential is huge. So we are going to have increased focus on penetrating our export markets deeper. So these would be 3 priorities, I would say.
Thank you, Deepak ji. There's a question from Kanwar Sahni. Kindly give some insight on the Kenyan market. What kind of market do we see in Kenya or the whole of Africa?
Well, as you know, Africa is a developing, continent, and our current contribution in Africa
is about 3.7%.
Is currently very low, whereas Africa has a great potential. You can see only 3.7% of our total exports is to Africa, but while the market potential is huge. So we have signed a term sheet with the factory in Africa, in Kenya, to cater to the African market, mainly Kenya and some COMESA markets, the neighboring countries in Africa. So right now, as you can see, that we are just very, very small in Africa, and even that percentage, as I mentioned earlier, that Pentonic has been accepted very well in those countries where we have exported. So yes, I think that will operating from Kenya will help us increase our penetration more rapidly, I would say.
Thank you, Deepak ji. There are questions from Pranav Parekh. What is our dividend payout policy?
So, so far, if you will see, of course, yeah, we did not have any declared dividend policy so far. And if you observe last 10 years, we have been paying almost 30% of our, net profits, towards dividend. That's been our payout. But this year we, decided a policy that we should pay a minimum of 20% to 25%. So you can say that 25% is our dividend policy. So it can range from 20 to 25%. And as you would observe that we have been consistently paying dividend ever since the company was listed, except the COVID year, of course.
Thank you, Deepak. Follow-up from Pranav. Can you please throw some light on the economics of the Africa acquisition, as well as our expected sales and margins there over the next few years? Also, what were our margins in exports versus domestic sales in the last 2 years? Too many numbers.
Okay, yeah. So, well, this majority in the Kenyan factory, the ticket size is very small. It is like just about 4 crore rupees, you know, when converted into Indian rupees. And this is going to be our first ever, you know, overseas, venture or adventure, I would say. I would say that it is really too early to comment on how much we will be able to do, but definitely right now I'm not able to give you the numbers because exports is being looked after by my son. But this is a running factory and they already have a brand, and they are producing about 4 million pens a month. And so with Pentonic, like we are planning in the first phase, we are planning to produce 2 million pens. So we are actually, we have developed a capacity of 2 million Pentonic pens in the Kenya factory. And, but I don't know that how much time will it take for us to consume that capacity. So, so let's see, I mean, how it goes. As I said, that this is a low ticket investment, and we thought that, you know, it would be worthwhile. So far the gross margins in exports is concerned, definitely we have better margins than the domestic, in the exports. So, yeah.
Thank you, Deepak. Friends, we are actually running quite tight. We have time for another question from Astha Sundarka. Request all other participants to please send their questions into me and I'll take it up with the management. Astha, please go ahead. Astha, you need to unmute yourself. Yeah.
Hello.
Yes, Astha, please go ahead.
Good afternoon, sir, and thanks for the opportunity. My question to you is that the polymer, which is the raw material, so how much of it is domestically sourced and how much of it is from outside in percentage terms?
So, most of the polymers, except, polycarbonate, is sourced from India. So you can say that almost about 80% of it is sourced from India and about 20% from overseas.
Okay, and sir, are we looking to hedge polymer because the prices are quite fluctuating?
Well, we have not done this hedging so far, since we are mostly procuring from local companies, and I don't think that they have any such hedging, hedging scope. But yeah, I would check with them if there is any way that we can hedge the polymer prices. Yeah.
Okay, thank you, sir.
Yep. And just wanted to share that this is the question which I was expecting. In our total cost of production of a pen, polymer is about 30%. So I think that could be one good information.
Also that we have 20% export also. So there is a reasonable amount of internal self-hedging which is already happening.
That is for the foreign exchange, yes.
FX, yeah. Not for the polymer.
Yeah, that's okay. For the foreign exchange.
Got it, sir. Got it. Thank you.
Thank you, Astha. We'll probably take the last question from Gaurav Somani. He sent it on the Q&A board. Gaurav, I think Deepak ji preempted your question. He's already answered the polymer cost as a % of production cost. Next is, can you please reiterate margin guidance for FY25? Is it 15%?
Yeah, it is.
Yeah. The
EBITDA margin is 15% guidance, around 15%. So don't hold me if it is 14.99.
So yeah, so frankly speaking, We have potential to do better, but that's what we like to guarantee.
Thank you, Deepak ji. There's a participant as an anonymous attendee with multiple questions. Request you to mail your questions to me because I wouldn't know whom I'm answering to. And the others are follow-up questions. So I request all of you to, if you can please forward your questions by mail and we can take them up. Thank you very much, participants, for attending this earnings webinar of Linc Limited. Thank you very much, Deepak ji, Dujari ji, and Sanjeev ji for taking time out and interacting with the investors. Deepak ji, your closing remarks, please.
Yeah, thank you very much. And I would say, Naveen, I would like to thank all the participants for trusting Linc Pen, and we would like to keep their trust and do our best to our potential. That's it. Yeah.
Thanks, Naveen, for arranging this. Really appreciate it.
Thank you, Sanjeev. Thank you, ladies and gentlemen. That concludes our webinar, and have a wonderful day ahead. Thank you.
Thank you. Yeah.